Hey there, Lincoln here from bullacademy.org. Today I want to talk to you about Peter Lynch on timing the market. Peter Lynch is considered the greatest mutual fund manager of all time, achieving over 29% annualized returns at Fidelity over his tenure, which is amazing considering that mutual funds usually don't do anywhere close to that well. And I don't like mutual funds because, of course, they charge you fees to manage your money and get you mediocre results, and you could do better than them. And Peter Lynch agrees. He is a fund manager who says that you can beat the market on your own. You don't need a fund manager. So he will happily take your money and manage your funds for you, but he says you don't need him. Retail investors can do it on their own. But over the last few months, I've been hearing lots of rhetoric from people out there on Twitterverse and other places on the internet where investors congregate and people like to troll. And people like Chris Sacca and other people from CNBC and, the big names out there saying that, retail investors shouldn't be so proud of themselves for making lots of money in a recession. Okay, well, Peter Lynch disagrees. And this is why he disagrees. Let's read a quote from Peter Lynch himself. You get recessions, you have the stock market declines. If you don't understand that's going to happen, then you're not ready. You won't do well in the markets. If you go to Minnesota in January, you should know it's gonna be cold. You don't panic when the thermometer falls below zero. And in another quote, he says, I didn't spend any time predicting the economy or the stock market. I spent all my time looking at companies. And he also said, people spend an unbelievable amount of mental energy trying to pick what the market is going to do, what time of the year to buy it, and it's just not worth it. So why did I read those quotes? Well, it's to emphasize that it doesn't matter that the stock market goes up and down, and it doesn't matter that we made lots of money in a recession. And that's no reason for the big guys out there to talk down to us, telling us that, we couldn't do it in a normal economy. Well, we did. We were investing before the market crashed. And when the market crashed, because the big guys went away and everyone got fearful and ran away, we did what Peter Lynch says to do. He says when the market goes down, as it will go down, because that's normal, that's what happens, markets go up and down, you should buy more. It's a great opportunity to buy. So all these big wigs out there talking about, you're lucky that the market went down. No, we're not lucky. We just were there when you guys went away. That's it. We came to the table when you all got scared because you thought the market and everything was gonna just burn. And we said, okay, you guys run. We'll pick up your chips, just like Warren Buffett said. He said recessions are a great time for transferring wealth. Just as he said, the stock market is a vehicle for transferring wealth from the impatient to the patient, right? So it's not about luck. Unless you define luck as preparation meeting opportunity, then yeah, you can call it luck. We prepared, we saved our money, we invested, we made some money, and we moved some money from our wins to the stocks that you people out there, the big wigs, said were doomed. And you sold off billions of dollars in stocks, and we were there to pick it up. So the reason we did that is because we are not afraid of losing like the big guys are. The mutual fund managers out there, the big money, the smart money, right? Smart money. Those guys are more concerned with not losing money than they are with having the chance to make money because they don't want to look bad in front of their pals. So when the market gave some hints of going down, they ran away because they want to make sure they don't lose too much money because they have to come back at the end of the year and say, hey, look, we didn't lose your money. Your money was safe. And we got you 1% or 5% returns this year. Pay us our 3% fees. That's what they're concerned with. They want to look good. That's it. They want to keep looking good, not losing money, making mediocre results just to show their clients that, hey, I kept your money safe. And on top of that, I got you market returns, 6%. I got you the index. I got you the S&P 500. But retail investors say, hey, we're not going to time the market. We don't care what the market is doing now. We believe that in the future, the long term, the U.S. economy will continue to do well. Companies will continue to grow. And if we pick the right companies and we believe in them, we understand them, and we hold them for the long term, we'll be fine. So Peter Lynch says the same thing. He says, I don't pick markets. He literally said, I don't pick stock markets. I don't time the economy. I can't predict the future. But the mutual fund managers, the big wigs out there, want you to believe that you just got lucky last year because the economy went down. Well, Peter Lynch made billions of dollars buying in when the economy went down, and you guys all praise him, right? They all praise him because he managed to turn millions of dollars into billions of dollars. But when retail investors do it, they come and talk down to us. Peter Lynch bought the recessions. He says, when the market goes down, great time to buy. So retail investors said the same thing. Oh, you guys are running away, we're going to buy. The whole point of this video is just to point out that don't let those people tell you that you can't replicate your success, because your success is not predicated on markets crashing. I bought Tesla in 2019 when the big wigs said Tesla was doomed to fail. I bought Upwork in 2019 when the big wigs were running away and saying that it was a sell. I bought Beyond Meat in 2019 before the recession. So my gains were not only predicated on the recession. Sure, I made lots of money from buying some depressed stocks like Jumia, but Jumia was not depressed because of the recession. It was depressed because people were afraid of the African emerging market. So I looked at Jumia and said, hey, the African market is going to grow. Jumia is the leader. They are doing very well. They're making the right ancillary businesses with Jumia Pay, Jumia Logistics, and they're in specialized markets. They go in and they dedicate their resources and time to those markets and don't try to take on the entire African continent as one. So, hey, I like this company. I'm going to buy it. While everyone else said it was down, I bought it at $5. Today, it's at nearly $60 per share now. Tesla, I bought it at $191, is now above $4,200 if you account for the split, 5 times split. I bought Upwork when they ran away because of restructuring. I forget what price that was at, but it was very low. And that was before the recession. Sure, I bought some other stocks during the recession, but that's because I liked the company, not because it was just down. None of this is complicated. It's really not that complicated. They want you to think that it's complicated and you only got lucky so that you can go and pay them management fees to manage your money and get your mediocre results. Don't do it. Don't listen to them. You are able to make great returns on a long-term basis by picking your own stocks. So long as you are dedicated to doing the research, to look into the company and deciding whether or not you understand it and believe in it and plan to hold it for the long term. And if you think that the company is making money today or will make money in the future, and if they can lead the market or capture enough market share, and they have enough cash in the balance sheet to weather any storms and to continue to grow, and if you believe you have enough time to hold them to reach your goals, pick companies, don't time the market. Pick companies, don't time the economy. Pick companies, don't time interest rates. You won't win that game. That's what Peter Lynch says. And because you won't win that game, the mutual fund managers, the big wigs, telling you that you aren't smart enough and you got lucky because they want you to go out there and invest in the index funds and stay poor. I don't know what they actually want, but that's the impact of their statements. People will believe them and they will put their money into index funds that will get them mediocre results. And they will pay the mutual fund managers lots of money to get them mediocre results. It's just disingenuous and it's rude telling people they're lucky. Let people have their wins. If they're winning, let them win. I don't like swing trading, but people in my Patreon community swing trade and I'm happy for them. They win. They just made it big on GameStop. And I say, hey, I wouldn't do that, but I'm happy for you for your wins. Let us have our wins, Chris Sacca and the rest of the big wigs out there and the mutual fund managers on CNBC telling us that we're not smart. Just because they are more concerned with not losing than they are with winning doesn't mean we have to be. We can take risk and we're not beholden to any clients. The only clients we have are ourselves and our families. So we can decide how much risk we want to take and we can be risk on. They can't be because they can't lose their clients' money. Their job is to not lose money, not to make money. That's what they do. They would skip out on the chance to make lots of money just to avoid losing a little bit of money because it makes them look bad. And so when we win, that feels like a personal shot at them. And they come and tell us on CNBC, we're lucky and it's going to all burn down. Well, those Tesla investors who were investing in Tesla when people like Jim Cramer were saying, don't buy Tesla, it's not worth it, it's not good, and you should sell Tesla. Those people back from 2015, 2018, 2019, they're millionaires now. They're millionaires. Started out with a couple of $10,000 and now, 100 times that? Hey, the proof is in, not the pudding. The proof is in the numbers. You can beat the market consistently if you just do your research. You don't need to be one of those bigwigs and talk down on other people who don't mind taking risk on smaller companies. Peter Lynch says, look for the 10 baggers. Those are the smaller companies with great growth potential that you know and understand because you are on the ground floor doing the research and you plan to hold it for long term until you meet your goal. And you have to understand your own goals. And you have to understand what kind of companies you're invested in. So when I go out to look for companies to invest in, I'm looking for companies that are small to medium and I believe meet my investment criteria and can grow their revenues consistently and at a fast pace because I'm still young, I'm still poor, I want to build my wealth, and they can help me do that. And once I reach the point where I have enough wealth, then I can reassess my investment in that company and see if it still meets my criteria. And if it doesn't, then I can let it go. But if it does, I'll keep holding it. That's it, right? And one day I will be rich enough where I will be less risk on, like the big wigs and the people on CNBC. But what I won't do is come out and tell retail investors that they can't do it without me, that they're not smart enough, that they got lucky because the economy went down. The economy goes down every 5 years. It goes down, it goes up and down. Everything goes up and down. The stock market goes up and down. So the people who win are those who have enough risk tolerance to buy when the market goes down. When the big wigs sell off their shares. When they're over there talking about, oh, I'm going to time the market and I believe it's going to stay down and it's going to be a V shape or W shape or a K shape or whatever shape because their job is to time the market and not lose money, retail investors come in and say, hey, this company still makes sense. They're still the leader in the market. They still know how to make money and grow their revenues. They still have a plan to get through all of this. They can go raise more money. Their products are still the same. They still meet my investment criteria. The fundamentals are still the same. So why not buy them? Upwork, Jumia, Tesla, so many others. Even Neo, if you like Chinese companies. There are just so many opportunities out there for retail investors to make lots of money because what we do that the mutual funds can't do is bet on small companies. The mutual fund managers are out there betting on saving their own butts and keeping their clients' money on the blue chips, on the big companies, on the FANGs, like Facebook, Amazon, Apple, Google, and Netflix, because those are safe investments. They're big enough. They're on their radars. And no one's going to laugh at them if Google fails because no one could have seen that coming. But if Tesla fails and they invest in Tesla, they will be laughed out of town, out of Wall Street. Because why would you invest in a car company that doesn't produce lots of cars as Toyota and GM and Ford? Well, they don't understand that Tesla is not just a car company. And even if they do, they cannot take that risk. They're not risk on. You build wealth by being risk on. And retail investors want to build wealth. The poor want to become not poor. So we take risk that the big guys don't want to and can't. Even if they try to, they might lose their jobs, they might lose their credibility, and be laughed out of their profession. So I understand why they talk the way they talk, and you have to too. You have to understand the incentives behind these people's actions. People like Chris Sacca, I don't understand why he would say the things that he say, but the people on Wall Street, they have a goal, and their goal is to get more clients. And the more clients they get, the more money they make because they charge management fees. People charge you to manage your money. Why would you do that? Why would you keep your money in the bank, right? Savings account. They give you 0.01%. Same thing with the fund managers. Instead of giving you money, they take it from you and then maintain your money, but show you a little bit of growth and say, hey, look, I kept up with the S&P 500, which you could have done yourself. If you want to keep your money safe and get a little bit of growth from the S&P 500, do that. Go invest in the S&P 500. I don't like to, but I think that if you don't want to pick your own stocks and take on more risk, but still want to grow a little bit, much more than the savings account, 6 to 10% a year, S&P 500 is great for that. Go invest in the S&P 500. Don't give it to the guys on CNBC. You can keep your money safe just on your own. And you're not lucky because you invested during a recession. You're smart because you were able to take the risk and you were willing to take the risk to invest when they wouldn't invest. They were afraid of losing their money if they timed the market incorrectly. Peter Lynch says, don't time the market. When the market goes down, buy. When the market goes up and you think your companies are still good, keep dollar cost averaging. Buy up and buy down. Just buy consistently and hope for the long term until you meet your goals. Keep your time horizons in mind. If you're investing for 5 years, keep that in mind. If you're investing for 20 years, keep that in mind. And keep reassessing your companies every year, every quarter. See if your company still makes sense. But don't just throw money at everything. If you are one of those people who just try to buy whatever's going up, then yeah, the people on CNBC are right to talk about you and say you got lucky because you bought Kodak right before they got a deal from the US government and shot up 1,000% in one day. But if you're out there looking for companies that you'll know, understand, and believe in, not the pharmaceuticals who are getting the patents for the COVID vaccine because you were able to get in right before their clinical trials and you actually got lucky on that, but then you didn't understand why it went down after the FDA said that they can administer their drugs to the citizens, then yeah, maybe you got lucky and then unlucky and they were right that you lost your money because you didn't know what you were doing. But if you're out there picking companies that you understand and that you plan to hold for the long term because you really know what they do and can understand it and can explain it to a kid very simply what they do and why you think they're going to continue to do well in the future, then you're not being lucky. You're doing what you're supposed to do in the stock market. You're just investing. That's what investing is. What did you know and when did you know it? Well, I knew Tesla wasn't going to fail in 2019, and I knew that in May of 2019. And I bought at $200 per share, whatever that average was, 198. And less than a year later, that was 7x. And now it's, what, 22x? It's not that complicated. Tesla may be overvalued right now or not. I don't know. But what I do know is that over the long term, Tesla will continue to grow because they're leading into a new revolution. They're a pioneer. Same with SBE, ChargePoint. Same with Cloudflare Net. Same with Jumia. Same with Tattoo Chef Inc. And so many others. So yeah, you might have a few companies that don't do well, but if you just get a few right, you'll come out pretty well. You'll come out on the top, and you'll likely beat those mutual fund managers. And you can let them laugh. You can let them say you're lucky and that you don't know what you're doing. Let them say it. Only reason I'm coming out here because I want to talk to all of you and let you know that it's okay to do well during a recession, so long as you are doing what you think is right. And not just trying to time the market, and not trying to get lucky on the next GameStop or the next Kodak or the next Moderna and Pfizer. Because if you're trying to get lucky, if you're trying to time the market, if you're trying to buy on hype and FOMO, you will get burnt. And we've covered that before. Don't buy hype, don't buy FOMO, because you will get burnt on the way back down. So that's all for now. I just wanted to come out here. I know it's a little bit of a rant, but I thought it'd be important to just come out here and address what people have been saying, and I know many of you have seen it too. So I want you to know it's okay. You're not just lucky. If you're doing the right things, you're doing the right thing. And if you're here watching bullacademy.org, watching videos, learning how to invest and make the right decisions and be patient and understanding how to build wealth and then managing it and maintaining it, then you're doing the right thing. You're not just lucky. So let them keep talking, but you just keep investing correctly and for the long term and continue to practice the bull mentality, because the bull mentality is that we know what we invest in, we understand what we invest in, we believe in what we invest in, and we hold for the long term, because that's how we build wealth in this country. That's how we give ourselves the best chance of success on the stock market. So long as you keep practicing that, you'll be just fine. So if you enjoyed the video, you know what to do. Like the video below, subscribe to the channel, hit the notification bell, comment your thoughts below on these mutual fund managers, the CNBC guy, the Chris Sakas of the world, and let me know what you think. And of course, if you want to help the channel grow and reach more investors and get more access to me and get direct answers to your investing questions, then join us over at patreon.bullacademy.org. There are over 85 of us right now, so you'll be able to join all of us in the Discord channel where we share knowledge and discuss the stocks and SPACs that we're all invested in. to help one another build our wealth together. We do crowd research, we share diligence, we share news and rumors so that we can all do our own research and get in early on new opportunities. And that's where I share my early research into new companies I'm getting bullish on and share my thoughts on the markets and concepts that I don't share here on YouTube. And I share every buy and sell in my growth portfolio with our patrons as soon as I make them so that they can know what I'm doing and get more insights into why I make my decisions. And of course, you will have a chance of winning $200 every month just to be a loyal and engaged patron. So if you're interested in all of that, join us over at patreon.bullacademy.org. I'm Lincoln with bullacademy.org. Thank you again and have a great day.